The Heikin Ashi RSI Oscillator is probably one of the best indicators for scalping on Tradingview. This amazing tool can eliminate the ranging market really well and also spot the times when the securities are overbought or oversold. This information is useful for retail traders who are looking to get better trade entries and make more money. However, a vast majority of them don't quite know how to use the Heiken Ashi RSI correctly, which causes a lot of frustration and blown up accounts. So in today's video, I decided to share my best Heiken Ashi RSI trading strategy for forex, crypto, and stocks, which will make you massive profits like this on a daily basis. I will also backtest it 100 times so we can see the real win rate behind it. I will also improve this strategy towards the end of the video. Now, without further ado, let's get into it. Okay, so we're currently looking at the price of the New Zealand dollar versus the US dollar on a 1 minute time frame. I highly recommend you to use this strategy on lower time frames like the 1 minute, the 5 minute, or the 15 minute. So in order to actually build this setup, we need to come across here to our indicators tab. And the first thing we're going to be searching for here is HARSI, which is our Heiken Ashi RSI Oscillator by J. Rogers. Now let's double click on it, and in the input section, change the length from 14 to 10 and the open smoothing from 1 to 5. Then we're going to head across to our style section here and hide some of the options just like I'm about to do. And the reason that we made these changes to this indicator is to make it a little more smooth and easier to read. For our second indicator, we're going to need to add an exponential moving average. We're also going to need to come across to the input section of it and change the length from 9 to 200. We're then going to come across to our style section and change it from blue to white and also make it a little thicker. And for our third indicator, let's add higher high, higher low strategy, which is this one here. Then in the style section, we're going to be unchecking everything but higher high and lower low. Okay, the setup is ready, and now let's quickly understand the logic behind it. So the number one goal behind this strategy is to identify the trend direction first, and for that we're going to be using our exponential moving average. If the price action is below the EMA, the market is considered in a downtrend. This means that we're only going to be taking short positions during this time. On the other hand, if the price action is moving above our EMA, the market is considered to be in an uptrend, and we're only going to be looking to buy during this time. Once we identify the overall market trend, we're going to be waiting for the price action to pull back. For example, in a downtrend, a pullback is valid when the Heiken Ashi RSI gets overbought, yet the price action is not making new higher highs. This is very important because if the price action is making new higher highs, this might be a signal that the market is reversing. With that being said, a signal to go short is valid when the following conditions are met. First, the price action is positioned below our EMA. Second, the Heiken Ashi RSI gets overbought. For that, the candlestick can either touch or enter the red zone. Third, the Heiken Ashi RSI must form a red candlestick. Fourth, the very recent label on the higher high, lower low indicator must be lower low. If by the time the Heiken Ashi has printed a red bar and the price action makes a new higher high, this signal automatically becomes invalid. And the last condition is to have a bearish candlestick formed in the market when the Heiken Ashi turned red. So we would be entering our short position on the close of this trigger candlestick. Our stop loss will be set at our most recent swing high, and for this strategy you're not going to be setting a specific take profit target. You're simply going to be looking at the price action, and if it reaches the risk to reward ratio of 1 to 1, then you're going to have to move your stop loss up to break even. When the price action reaches a 2 risk to reward ratio, you're going to set your stop loss at 1 to 1 risk to reward. And then if your price action hits it, your trade will automatically be closed. Here is another example for a short trade. We see that the market is in a downtrend as we are positioned below our moving average. The Heiken Ashi RSI touched our red zone. Our red candlestick has been formed. The market has not made a higher high by the time that the Heiken Ashi has issued our sell signal, and the current candlestick is bearish. So we'd be placing our short position on the close of this trigger candlestick, bringing our stop loss up towards our most recent swing high, and we're going to be using the same money management strategy. So we see that it hit our first take profit target, so we'd be moving our stops to break even. In this example, we managed to move to our second take profit target. We then move our stop loss to our 1-to-1 risk to reward ratio, and then we managed to get stopped out in profit. So on this trade, we could have made good profit as well. The rules for entering a long position are exactly opposite. First, the price action must be closed above our EMA. Second, the Heikin Ashi RSI must get oversold. And again, the candlestick can either enter the green zone or simply touch it. Third, the Heiken Ashi must form a green candlestick. Fourth, the very recent label on our higher high, lower low strategy must be higher high. This means the price action is not making lower lows, which is a really good signal. If the market makes a new lower low before the Heiken Ashi issues a new buy signal, this signal automatically becomes invalid. And the final condition is to have a bullish candlestick formed at the time that our Heiken Ashi turns green. Our stop loss will be set at our most recent swing low, and just like with the short trades, you're not going to be setting a specific take profit target, you're simply going to be moving your stop loss every time the price action reaches a new risk to reward ratio. In this example, 6-to-1 was the maximum ratio that the market reached before the price action hit our stop loss. Since we're risking 2% of our account per trade, on this particular trade, we would have made 5 times the risk here. Here is another example of a long trade. We see that the price action is closed above our 200 EMA. The Heiken Ashi RSI touched the oversold area, and then the candlestick turned green. The market is not making lower lows, which gives us plenty of confidence when entering this long trade. So we'd be entering our long position on the close of this trigger candlestick, bringing our stop loss there towards our most recent swing low, and the same money management strategy applies. So in this example, the market reached a maximum of 5-to-1 risk to reward, but our stop loss was set at 4-to-1 risk to reward ratio. The market triggered it, and we closed this trade in some nice profit as well. The only downside I see behind this strategy is that you're not going to be getting a lot of trade entries. This is because the price action is usually making lower lows and higher highs at the time the Heiken Ashi gets overbought or oversold. If you do want to have more trade entries, don't worry, I will show you how to increase the number of them at the end of this video. Now let's do our backtesting to see how well this strategy works in different market conditions. Okay, the backtesting is complete, and here are the results. These numbers are absolutely crazy. The win rate for this strategy is 77%, and because we had this smart money management strategy in place, we increased our account size by nearly 1800%. Keep in mind these numbers will be different when trading live because of spreads and fees. We also managed to find those 100 setups within 3 months. The profit factor for this strategy is 6.93, and the largest profit trade we took increased our account size by 31%. We also had 8 consecutive wins against 3 consecutive losses. Now let me show you how to actually increase the number of signals that we get with this strategy. The only thing you'll need to do is take away our higher high, higher low strategy from the chart and add a simple volume tool. In the style section, we're going to actually add a moving average, and in the inputs, come across and change its length from 20 to 30. Now the conditions for entering a long trade wouldn't be that different. First, the price action must be closed above the EMA. Second, the Heiken Ashi RSI must get oversold. Then it must form a strong green candlestick without a lower wick. And at the time it does so, the volume must be green and our histogram must be positioned above our 30 moving average. So we'd be opening our long position on the close of our trigger candlestick, bringing our stop loss down towards our most recent swing low, and our money management will stay the same. For short positions, the rules are exactly opposite. First, the price action needs to be moving below our 200 EMA. Second, we're looking down towards our Heikin Ashi RSI to see if it did get overbought. Then we're waiting for the candlestick to turn red, and we don't want any higher wick. We're then looking towards our volume indicator to see if it is colored in red and positioned above our 30 moving average. When all of our conditions are met, we can safely enter our short position, bring our stop loss up towards our most recent swing high, and use the same money management strategy. So we actually caught up to our live trading right now, and this trade is currently running in some pretty nice profit. We're waiting for it to either move towards our 5-to-1 risk to reward ratio to move this up to our 4-to-1 target, or it will move down and stop us out at 3 risk to reward ratio, which is still some great profits. So let me know down below if you do have any questions. If you did enjoy, please leave a like, comment, subscribe, and turn on those notifications so you don't miss out. I love you all. Peace.